This is a story about what financial statements are. Now that you know why financial statements are important, Mary suggests that you might benefit from a tutorial on what they are. She indicates that once you achieve a basic understanding, then maybe together you and she can read and analyze Microline's actual financial statements. She begins by stating that there are four basic financial reports, or statements: a balance sheet, a statement of cash flows, an income statement, and a statement of owner's equity. She continues that each statement tells you something different about the company's past financial performance and current financial position. And she will explain further that while each statement is separately useful, that is, useful on its own, by itself, it is important to realize that the four statements are best viewed as a package, each statement enhancing the usefulness of the others. She goes on, let me draw some pictures for you. And let's begin with the balance sheet. The balance sheet describes the financial condition of a company at a specific point in time. In this case, January 1. In that sense, it's like a photograph or snapshot of the company's financial position. As of this particular date, January 1, it lists three categories of items: the resources the company can use to create profits in the future. These resources are called assets. The obligations owed by the company to outsiders, called creditors. These obligations are called liabilities. And the level of investment in the company made by the owners to date, which is called owner's equity. It is called owner's equity because the investment made by the owners represents their equity or ownership in the company. The balance sheet is constructed to ensure that the company's assets minus the company's liabilities, the subtraction indicated by parentheses, always equals the investment made by the company's owners. Let's try a quick example. Assume that the company's owners contributed $20,000 in cash to get the company started, which would create $20,000 in assets. In this case, cash that can be used to invest in things like machinery or equipment or vehicles. With zero liabilities owed by the company, $20,000 in assets less zero liabilities equals $20,000 in owner's equity. Assume further that the company borrows $10,000 from a bank, leading now to $30,000 in assets. In other words, the $30,000 of assets, which the company can use to make money in the future, were financed or provided by $20,000 in owner's investments or contributions and $10,000 in borrowings. Assets minus liabilities always equals owner's equity. This fundamental equation, assets equals liabilities plus owner's equity, is at the very heart of understanding not only the balance sheet, but as you will see later, all the financial statements as a package. In addition to the balance sheet, there are three other financial statements that describe the activities of the company. Unlike the balance sheet, which reflects the company's financial condition at a specific point in time, these three statements describe financial activities over a period of time. And this time period could be a year, a quarter, 3 months, or even a month. These statements are the statements of cash flow, the income statement, and the statement of owner's investments, called the statement of owner's equity. The statement of cash flows lists cash collected by the company during the period as well as cash payments made by the company during the period. Simply, cash in minus cash out. These cash flows are organized into three categories. 1. Operating cash flows. 2. Investing cash flows. And 3. Financing cash flows. Operating cash flows include cash receipts and payments associated with acquiring and selling the company's products, which are sold to customers, and or services which are provided to the company's clients. These activities are referred to as operating activities. Net operating cash flow is the difference between the cash inflows or receipts from the company's operating activities during the period and the cash outflows or payments from these same activities during the period. This number can be either above or below zero, that is, positive or negative, depending on whether the operating cash inflows during the period exceeded or were less than the operating cash outflows. Normally, a company wants this number, often referred to as net cash from operating activities, to be greater than zero, hopefully by a lot. It is an important measure of the company's performance during the period. Investing cash flows, the second category on the statement of cash flows, include cash receipts and payments associated with acquiring and selling the company's producing assets, such as properties, buildings, equipment, and other investments. These investments typically provide benefits to the company over more than one and often many years. Investing cash flows are also expressed as a net number, the proceeds from the sales of these kinds of investments minus the costs of purchasing them. Normally, net investing cash flows is a negative number because producing assets are acquired to help generate profits. They are only sold when judged no longer to be useful. As you might expect, successful and growing companies tend to buy more of these kinds of assets than they sell in a given period. Financing cash flows, the third category, include cash exchanges with the company's owners and creditors, cash receipts from and payments to those parties who provide financing to the company, such as the company's owners, banks, and other creditors. Examples include cash inflows from investments made in the company by its owners, dividend payments made back to the owners, as well as bank borrowings and the related repayments. Net financing cash flows, financing cash inflows less financing cash outflows, can be above or below zero, depending on whether the cash proceeds from these exchanges exceed or are less than the cash payments. This number is normally positive for new companies, for example startups, that are raising cash from owners and our creditors to fund future growth. For more mature companies that have been successful for a long time, this number is often negative because these companies are less concerned with financing future growth and more concerned with returning cash to the company's owners. The overall net effect of the operating, investing, and financing cash flows represent the change in the company's overall cash balance during the period. Thus, the statement of cash flows simply keeps track of the company's cash, where it came from, where it went, and at the end of the period, how much is left. The income statement measures the net income or loss the company made during the period. This number is often called net profit or net earnings. It consists of two categories. The first category is revenues, which is a measure of the value of the goods and services provided by the company to its customers and or clients during the period. Revenues represent the dollar value of the deliveries or services completed or earned by the company. And importantly, the completion of the delivery or service may or may not be accompanied by a cash receipt. Revenues are recorded in the books or recognized when the company has completed its requirement, which can occur before, at the time of, or after the receipt of cash from the customer or client. The second category is expenses, which is a measure of the dollar value of the assets used or liabilities created to directly generate the revenues. That is, expenses directly support the sale of the goods and services, helping to generate the revenues. Examples include wages and salaries paid or owed to employees, as well as the costs associated with such items as utilities, rent, advertising, and taxes. Again, like revenues, these items may or may not involve cash exchanges. Once determined, expenses are subtracted from revenues in the calculation of net income if revenues exceed expenses, or net loss if expenses exceed revenues. This number is the famous bottom line, used by many as a summary of how well a company performed during a given period of time. Roughly speaking, it measures the amount of wealth created by the company's operations during the period. Simply, if the company sells a product for $10 that costs the company $6 to produce and sell, the company has created $4 of wealth or profit. Together, net income on the income statement and net cash from operating activities on the statement of cash flows provide two important measures of the company's operating performance, both referring to a period of time. Net cash from operating activities measures how much cash was created by the company's operations, while net income measures how much wealth was created by the company's operations, a measure of performance a bit broader than cash. That brings us to the statement of owner's equity. It lists the changes during the period of time in the overall investment made by the owners. Owner investments in a company come in two forms: contributed capital and earned capital. Increases in contributed capital occur when owners directly invest in the company by contributing funds to the company by buying ownership interest in the company, often called stocks or equity shares. Decreases in contributed capital occur when the company buys these ownership interest shares of stock back from the owners. Increases in earned capital occur when a company earns positive net income disclosed on the income statement, and the owners choose not to withdraw these profits, leaving the earned funds in the company. This leads to creation of a concept called retained earnings, RE, past net incomes or earnings that have been retained in the company. For most mature and successful companies, retained earnings is the primary component of owner's equity. Decreases in earned capital, primarily retained earnings, occur when companies report net losses on the income statement and/or owners choose to withdraw past profits from the company in the form of dividends, which are normally cash payments from the company to the owners. Moving now to the end of the period, in this case December 31, 1 year after the date of the initial balance sheet, all the activities measured by the statement of cash flows, the income statement, and the statement of owner's equity are reflected in a new and revised balance sheet, which then describes the financial condition of the company as of the end of the period. This schematic describes a complete set of financial statements. Two balance sheets representing two photographs of the financial condition of the company at the beginning and end of the period, connected together by three financial statements, each telling us something different about what happened during the period. Let's conclude by briefly summarizing the entire process. The balance sheet, a statement or snapshot of the company's financial position at the beginning of the period, is changed by the company's business activities during the period, which are described by the statement of cash flows, which tells us what happened to the company's cash balance, the income statement, which tells us how much wealth was created by the company during the period, and the statement of owner's equity, which tells us what happened to the investment in the company made by the owners. All this leads to the balance sheet at the end of the period, a revised snapshot of the company's financial position, the current state of its assets, liabilities, and owner's equity, which in turn becomes the balance sheet at the beginning of the next period, and the process continues. This concludes our basic introduction to the financial statement.